Hello, welcome to ACG Wealth Management's second quarter investment review and third quarter preview. My name is Bobby Moyer, and I'm joined with my colleague Jimmy Pickard. The markets had a strong second quarter across the board. Domestic large cap stocks led the quarter. The S&P 500 returned 8.55% and is now positive by 15.25% year to date on a total return basis. Mid-cap and small-cap stocks performed well and were positive for the quarter, posting low single-digit returns, but they had a monstrous first half. The S&P Small Cap 600 returned 23.56% for the first half, and the S&P Mid Cap 400 returned 17.59%. International stocks were positive, but trailed the U.S. markets. After seeing interest rates rise through the first quarter, rates stabilized as the short-dated Treasury saw a rise in rates and longer duration bonds fell. The falling longer-term rates helped bond prices rebound. The Barclays Aggregate Bond Index had a positive 1.83% return for the quarter, but remains negative by 1.6% year to date.
Optimism was running high during the second quarter. The economic recovery in the U.S. during the quarter was strong as people began to travel more, go out to eat, and attend events. Demand outpaced supply, which pushed prices higher. Inflation was a buzzword thrown around everywhere during the quarter. Inflation can represent an overheating economy, which could cause the Federal Reserve to tighten monetary policy in an attempt to slow economic growth. The Fed believes this inflationary period is transitory and is being caused by a low base from last year, supply chain disruptions, and labor shortages. The Fed was less dovish following their June meeting, but they still remain committed to keeping monetary policy loose for the time being to help the economic recovery avoid stalling.
We roll into the second half of the year on a high note with strong expectations for the back half of the year. On average, the personal savings rate among Americans is at multi-decade highs, and household net worth continues to climb. Jobs are plentiful. Even though the unemployment rate is elevated, there are a record number of jobs openings, with many employers complaining about labor shortages. We expect many of the causes of the labor shortages to subside later this year. Given this current backdrop, it is easy to understand why so many market analysts are positive on the second half. There are a few points to remember. For one, the market is forward-looking as economic and company earnings expectations accelerated during the second quarter. The market began to price in this optimism. What investors will need to watch is if these expectations are fully or even partially baked in, or if the market got ahead of itself and may need to take a breather.
The Federal Reserve may be a driver of returns between now and the end of the year. As long as the Fed continues its easy money policies, this will provide a tailwind for the market. Stocks may get choppy once the Fed's rhetoric suggests that they will soon begin to taper their bond buying program. But remember, the Fed will only begin that process of tightening if the economy looks strong and sustainable. If the economic recovery looks tenuous, the Fed will delay tightening. This is important for investors to remember if markets go through such a period of volatility. The pandemic is not over and remains a risk to market growth. If we see the virus or its variants begin to spread rapidly, either among the vaccinated or the vulnerable, we may see governments add back restrictions that could impact the economy. This may be a lower probability risk than it was several months ago, but should still not be ignored.
We remain optimistic about the opportunities between now and the end of the year, but we have been surprised by the speed of the recovery and the lack of market volatility. It would not surprise us to see some volatility during the second half of the year. We remind investors to stay disciplined and stick to your investment strategy. Have a great rest of your summer.